Hi, I'm Sean Scallon, Managing Partner at Kingsgate Capital Partners, and welcome again to this episode of Five by the Fire. These short, sharp podcasts are designed to provide allocators and influencers of capital with a deeper understanding of the managers we represent and their strategies. In this episode, we have Blair Reid from RBC BlueBay, as well as Graeme Bibby, our advisory board member at Kingsgate and also CIO of Anseres Capital, which is the outsourced investment solutions group of Partners Wealth Group. Over to you, Graeme.
Thanks very much, Sean. And hello again, Blair. We've got some questions for you, the usual 5 by the 5 format. So let's kick off with the strategy itself. So where does global multi-asset credit fit within a diversified client portfolio today?
Well, thanks, Graeme, and thank you for having me. I think for multi-asset credit, a lot of investors use it in a different way. And so there's no right and no wrong answer. I think in different regions, it's used in different way. For most of our investors, they have exposure to equity or higher returning asset classes. They often also have exposure to very safe credit or very safe parts of the bond market. And the bond market is absolutely huge with all different sectors and a whole spectrum of what's available. And what we've tried to do in our version of multi-asset credit is really include a lot of asset classes often are underrepresented in what people own. And so that's going to be high yield, some emerging markets, convertible bonds, securitized credit, really a whole spectrum and array of really hopefully things they don't already have. And the purpose of putting them in there is really twofold. I think a lot of investors want ultimately just to own something they don't already have. So that gives them some type of diversification benefit. In the ideal world, this is uncorrelated to everything else. Of course, in the real world, that's not true. But you do get some type of, I think, real underlying diversification just by buying stuff you don't actually have. But ultimately, it is the income that investors or most investors come for. So when we think about fixed income, income's obviously in the name, and you can kind of choose where you want to be on that spectrum of income. And again, for a lot of our investors, it is a fairly stable, reliable source of income, higher than you can get in very safe parts of the bond market or developed market investment grade, let's say. So different uses for different clients. I think the underlying is always diversification and some type of income element. And the version that we look after is aiming for about cash plus 4%. So when I think about a much safer bond portfolio, it's typically cash plus 1-ish if it's high quality investment grade. Once you go into the, I guess the high yield or the high yielding asset classes, you can extract a lot more income. And the sweet spot for us is to really get as much yield as we possibly can out of these portfolios without taking on any undue risk.
Well, that's interesting that we talk a lot about income, but it's a high risk asset class. And in particular, in talking about how you do that, delivering reliable income, but you've also looked to protect capital as well, particularly in volatile markets. How do you manage those trade-offs? How do you do that?
Yeah, it's a good question, Graeme. There's always a tension between the two. And I think what is certainly different about bond markets versus equity markets is in bond markets, you have two types of risk. I always think of equity markets, you have a return and a lot of risk is looked at in terms of volatility or drawdown. The same in bond markets, but with an extra leg of risk, and that is credit risk. So when I think about risk in bond markets, it's twofold. It's what is the volatility, what is the potential drawdown, but also what is the credit risk, what is the chance someone doesn't actually pay us back. So you're balancing up effectively a triangle of these three things: credit quality, yield, and often drawdown. And so for us, when we're trying to strike that balance, ultimately you're looking for the most optimal allocation to balance those. So when we think about credit risk, which in its purest form is just the chance of not getting your money back, the further you go down the credit spectrum, the riskier things become. So when we think about multi-asset credit, we think the most attractive area is you step just outside investment grade, which is typically rated BBB, and into the BB space. So the very much the safer end of sub-investment grade credit, as it's often called. And that is how we really think about minimizing the credit risk. In terms of volatility and drawdown, there's a number of things you can do. So one thing, it obviously depends on the bonds you buy, and because they're linked to global markets, you are going to take that volatility day to day or month to month, certainly something that's happened this year. But you can hedge the downside as well. So where we often have a very short-term view, perhaps weeks, not months, that markets may fall, we'll often use some type of derivative hedge just to protect the portfolio. That the costs of selling and buying back bonds can be non-de minimis in some of these markets. So the idea of using some cheap way to protect from market falls has worked very well in the past. And so when you break it all down, the most important thing about income is the contractual nature of the cash flows. So when I think of the difference between equities and bonds, in bonds, it is about contractual cash flows. We buy a bond off a company or a government. Unless they default, we get the cash flows and we know what those cash flows are up front. So for us, it's really mixing all those things together. But the absolute key to delivering income is contractual cash flows. And although the mark to market on bond portfolios can move around, the cash flows are extremely stable for those taking income.
Thanks, Blair. And so you've talked about the diversification across many areas of credit. You talked about the income and the trade-off with credit. With that wider universe, what are the drivers behind your decisions to allocate into and out of sort of areas that you can, such as regions and sectors?
Yeah, so there's a lot of different things to take into account. One is certainly time horizon. So we are not day traders in the bond market. I don't think anybody is. It wouldn't be cost effective. So you're generally taking a view which is kind of in the 3 months to 18 months zone for a lot of the types of bonds we're looking at. And what you're really trying to play off is where is the best risk-adjusted opportunities. So we build these portfolios from both the bottom up and the top down. So we look within asset classes, so within high yield, within convertible bonds, within emerging markets, within securitized credit, where are the best opportunities? And we build a portfolio of those best opportunities. And then from the top down, we look at, well, overall, how do we want to calibrate the overall risk of a portfolio, and what areas will we accent? So you're really bringing together top-down views of what's happening in the world, bottom-up views of the portfolio. At the moment, we're pretty well diversified across everything. So in times of perhaps greater uncertainty, where we find ourselves at the moment, there's just a prudence in really spreading that portfolio out. Regionally, we don't have an awful lot of risk in the Middle East. And at the moment, we're in the process of reallocating some risk, which is European in the portfolio, particularly in something like CoCo or AT1 bonds, back into the US. So I would say that the biggest change at the moment is probably a regional allocation change from Europe to the US, US being more insulated, we think, from the Strait being closed at the moment. But in terms of sectors, a very wide array. And I think the most interesting one at the moment for us is probably convertible bonds. So convertible bonds are a hybrid asset class within the bond market. They're a bond that they pay a coupon, but they can be exchanged for equity under certain conditions if equity prices go up. And so that's the nature of them. But the more interesting thing is who issues them, and that is a lot of the tech companies. So in a lot of bond markets, it really is about the old world. These are established businesses, whereas with convertible bonds, you can really play the new world. So within the portfolio, there's been a particular accent on convertible bonds at the moment and playing that new world trade.
Yeah, and that's an interesting combination of where you're positioned now, a little bit of where you're thinking about in the future, maybe sort of bridging from what did drive performance over the 12 months, and then where might you think allocating in the future, in the short term or medium term, what's most overlooked in the credit universe that you're looking at?
Yeah, I think in terms of most overlooked, I think investors A lot of them have had an over-reliance probably on equity markets versus bond markets, and have not had a great allocation to this area of the credit market. So I think for most of our investors, and what drives a lot of flows is this idea of getting access to markets that aren't already in portfolios. And the attraction in a world certainly where spreads have come in a little bit, so the extra return you can get in many of the bond asset classes has fallen. Certainly in the high yield, the loans, the securitized credit emerging markets is still a very attractive return to be had. So how I see this evolving over the next 12 months, let's say, is this pocket of volatility we're in at the moment. We're running risk at roughly about 110% of our versus our average level of risk. So still happy to take risk in this environment. The securities we have, we think will pay us back regardless of what happens. And you will come out, and we view what's happening certainly in the Middle East at the moment as something that all parties wish to resolve. And whilst has quite a dramatic impact in the short run, probably as we hit mid-year in the second half of the year, perhaps less so, perhaps with an elevated oil price and some inflation that comes along with it. So in terms of what we'll be looking at for the rest of the year, it'll be probably less about top-down macro and more about bottom-up opportunities. So it really is within these markets, where are the best risk-adjusted opportunities? And I think the great thing about multi-asset credit, a lot of it is about what asset classes you're in, but the key driver of performance over the medium and long run is really what actual bonds do you hold in that portfolio. And as I said, I can see us taking a little bit more US risk over the course of this year. And the idea of trying to get more access to technology by convertibles, I can see that playing a bigger role as well.
Great. Well, look, thanks very much, Blair, for all those great insights. And what I find really interesting is that there are a lot of areas that you can invest in. You're very diversified, and you're able to access things that aren't in traditional bond portfolios. So for our listeners, if you want to find out more about global multi-asset credit, please get in contact with the Kingsgate Capital Partners team or head to the Kingsgate website. Thank you for listening to 5 by the Fire.